Have you ever wondered why investors, economists, and even the Federal Reserve closely watch something called the 10-year Treasury Yield? It may sound boring at first, but this single number quietly influences everything from your mortgage rate to the strength of the stock market. It's more than just a percentage, it's a signal, a forecast, and a mirror of investor confidence. If you want to understand where the economy is headed, this is your secret weapon. Stay with me, because by the end of this video, you'll see how powerful and important this yield truly is. The 10-year Treasury Yield represents the return investors get when they buy US government bonds that mature in 10 years. But it's not just a return on investment, it's a benchmark. And here's why that matters. When people talk about the US bond market, this yield is one of the most talked about figures. It reflects investor confidence, inflation expectations, and future economic growth. If the yield rises, it usually means investors expect stronger growth and possibly higher inflation. If it falls, it might signal fear, uncertainty, or an upcoming slowdown. Let's break it down even more. Imagine the US government needs money. It borrows from the public by selling treasury bonds. These bonds are seen as one of the safest investments in the world. When demand is high, the yield goes down. When investors get nervous and move their money into bonds, it drives yields lower. Now, how does this affect you? Simple. The 10-year Treasury Yield is closely tied to interest rates on things like mortgages, car loans, and even credit cards. If yields go up, borrowing becomes more expensive. If they fall, loans become cheaper. So whether you're buying a house or investing in stocks, this yield can silently influence your decisions. Here's the twist: sometimes the yield can drop even when the economy looks strong. That could mean investors expect trouble ahead, or that global demand for safe US bonds is rising. Traders also look at interest rate trends to predict what the Federal Reserve might do next. While the Fed doesn't directly control the 10-year yield, the market reacts to Fed decisions on short-term rates, and that ripple affects long-term yields. So why is everyone watching this one number? Because it connects the dots between inflation, the economy, global investment, and personal finance. It's like an economic thermometer. If you've made it this far, now you know the 10-year Treasury Yield isn't just for Wall Street experts. It touches your life more than you think. If you found this video helpful, hit that like button and subscribe to our channel. We break down complex financial topics in simple, clear ways just like this. Thanks for watching, and stay tuned for more.